This is InvestTalk. Independent thinking, shared success.
Hi, this is Brian from San Jose. I have a long position in Primerica, ticker symbol PRI. It's got a pullback, so I'm wondering if I should sell it now. Thank you. Bye-bye.
Primerica, it is a financial services company. It does insurance and investment product sales. Their term life insurance is about 57% of their revenue. Investment and savings segment is about 34% of the revenue. Now, year to date, it's down about 4%. Past 3 months, down 9.53%. And over the past 52 weeks, it is up 10%. Now, looking at earnings, didn't look too bad. 9% year over year growth as of Q1 2025. They've been repurchasing shares. They have a pretty solid and consistent dividend, which floats between, looks like 1.2 and 1.6%. And from a debt perspective, right, this is a $8 billion market cap company. They don't have too much long-term debt, only about $2 billion, $1.955 billion in debt. Take a look at the growth of net interest income. Well, pretty solid growth, though it is projected to dip into next year. Earnings per share in 2024 looks like actually negative. Now, I'm sorry, that's growth. Apologies. The earnings per share was not negative, but they did earn less per share than they did in 2023. From a relative valuation perspective, looking pretty cheap, trading at 11.8 times forward-looking earnings. But I think a lot of their growth is coming from some robust growth in client investment assets. And so the question is, does that momentum stand? We've seen a lot of investment managers be hit pretty hard recently because, again, that dual compression of fees and also assets being taken off the table towards the side. Now, for this company, frankly, I think that the overall growth in revenue, net earned interest, and net income has really slowed, right? It was in the 10s, up at 9% in 2019, 12% in 2020, 13.5% in 2021. Really gone down into the low single digits, projected to be 5.2% this year. So with growth slowing, with bottom line growth slowing as well, I don't know. I think there are better opportunities out there. And maybe this name is cheap for a reason. So for Primerica, ticker PRI, going to have to pass. Thanks for the call. All right, let's tackle a question from the InvestTalk YouTube channel from our friend and loyal viewer, Eva Cook. While you're over there, if you prefer to watch our videos or you just like to watch it as well as listening to our podcasts, if you have a question, you can just leave it in the investment or in the comment section of our InvestTalk YouTube channel. That is just InvestTalk with 2 T's. This question is about Samsara, ticker IOT. It says, I've been watching Samsara for a while and was thinking it might be a good time to invest. What do you guys think? Well, Samsara is a relatively new company. It's a cloud-connected platform company for industrial and enterprise clients. It was founded in 2015, and since then it has risen to about $22.8 billion in market cap and had phenomenal revenue growth, growing from $110 million in revenue in 2020, projected to be $1.5 billion in revenue this year, logged $1.24 billion last year. From a performance perspective, although it's up 30% in the past 52 weeks, it's down 11.4% year to date. Probably because, as you've seen tech pull back broadly across the year and especially in pockets, companies that don't make money are going to be more affected by this. This company has yet to make money in its trading history, though you see from this net margin, it's marching in the right direction, possibly being positive for the first time in fiscal year 2026, which for them ends in January. But they have had a lot of slowdown. In spite of this movement towards profitability, revenue growth has slowed down pretty significantly compared to what they saw in the earlier part of the past 6 years. You also have some valuation dynamics that are not very favorable right here. Forward-looking price earnings, 86.5 times, below its average at the low, but still very high. Price to cash flow, 135 times. Price to sales, 16.2 times. Very, very, very expensive. Recently they did reinforce their guidance, but in spite of this, in an environment where rates may be sticky upward, where if tech does continue to have a rotation out of it, companies that don't make money, newer companies are going to suffer the most. I think there's a lot of excess risk in investing in a name like Samsara. They might have a bright future, but I think it is better to be invested elsewhere within the tech space, a more established company that can stomach some of the volatility that we should expect to see in the second half of this year. That is Samsara, ticker IOT. Thanks for watching, and thank you for leaving a question on the comment section of the InvestTalk YouTube channel.
Hi, this is Van from Coeur d'Alene, Idaho. I'm wondering what you guys are thinking about the old Apache. It's an oil company. It's now called APA. Thank you very much. Love your show.
Alrighty, so the question is about APA Corporation. It is an integrated oil company. They operate in the United States, primarily where most of the revenue comes from. They also operate in Egypt and the North Sea. Now, this company has had a rough time as of late, certainly on a downward trend since July. It's underperformed its industry every year going back to 2023, including this year. Over the past 52 weeks, it's down 27.46%. And in spite of a little bit of a rise from the lows at 15, and really in the past couple days from about $16.50 to where it is now at about $20 a share, it did benefit from a rise in tensions, but it's still lagging a lot of its competitors. And so I can understand, maybe you're looking at this name and saying, okay, well, it's trading at 7.5 times forward-looking earnings. Should this be a name that I get into? But even though it has pretty decent cash flow, even though it has been buying back shares pretty consistently over the past couple years and does pay a 4.8% dividend yield, it has quite a bit of debt, $5.4 billion in debt on about an $8 billion market cap company. It also has about 10.4% short interest out there. And so the market is telling you, well, it's had a rough time, but we think this company is probably worth even less than it is right now. It is like any other oil company, like any other energy company, going to have revenues that ebb and flow with the commodity that it is exposed to, in this case, oil. And you see that in its margins, right? In 2019, 2020, lost a lot of money. In 2021, started making money again. Real peak in 22 and 23, back down to about 13.8% this year. Revenue all over the place. For me, in an environment where you have a lot of push and pull here, you have lower demand, you have supply that may be lower than what a lot of people thought, but still, the IEA is saying that there's going to be an oversupply of oil in 2025. And then you have on the other side rising tensions that could push oil prices higher. Because of that volatility, I would rather be invested in a more globally diverse, certainly one that stays a little bit more out of the Middle East, more globally diverse, larger company that has a lot less debt on its balance sheet. So I think I tend to agree with the market here, with the shorts out here, that I would not want to get into APA Corporation, ticker APA. Even though the forward-looking price earnings looks juicy, sometimes there's a reason why things are cheaper.
Hey guys, my name is Peter from Columbus, Ohio. Hey, I appreciate the show. Just calling to get your opinion on AT&T as just like a long hold. I used to listen to the show quite a bit. I haven't listened in probably a year, so I'm getting back into it. I apologize if you answered this recently. I'm just going through a backlog. But really, I just want to have some all my spare money. I've got all my retirement stuff maxed out, IRAs, 401ks and stuff. So I just want to put some extra cash in something that's long, pretty safe. Obviously a bunch of stocks, not just AT&T. So I'm just looking at this as one of them. So the symbol is T, AT&T. Appreciate it. Thanks.
AT&T is a household name. It's one of the largest global telecommunications companies in the world. It is a very, very large company. It's got about $200 billion market cap. But but it also has a lot of debt, $143 billion in debt. Its cash flow, pretty solid, but hasn't really been growing much in recent years, and its profitability has been ebbing and flowing from positive to negative over the past 6 years. Supposed to hit a post-pandemic high of about 12.5% net margin this year. Its forward-looking earnings, about 12.8 times, is near the upper end of its 5-year range. And that's because over the past 52 weeks, it's up 53.24%. One of the reasons why it's up 53.24%, well, they've made some pretty good progress towards their goal of massive deployment of fiber networks. They also added 324,000 postpaid phones and 261,000 AT&T fiber new net subscribers in the most recent quarter. Revenue and EPS in line with expectations, and announced a $3 billion share repurchase program, which is great because the trend has really been the opposite direction. Slight issuance of shares since 2021. Now, they do pay a dividend, about 4% is where it has been on average throughout the year. Right now, it stands about 8.2%. And what you're seeing here is hopefully the reversal of a trend, right? They did have a high in 2019, and it's been downward ever since in terms of revenue. Their big growth strategy, again, laying those fiber lines. But you've also seen a lot of people leave both AT&T and Verizon. Their margins, like I said, projected to be 12.5% this year. Again, here's this net operating cash flow for you. Like I said, similar range, very stable, free cash flow, headed in the opposite direction as well. So for this name, from a momentum perspective, it has some pretty strong momentum over the past year, really just straight up, but it's lost a lot of its speed once it hit that 28-30 level just a couple weeks ago. And so my issue with AT&T is really from the leverage, right? They have a leverage ratio that's about 1.4 times higher than the industry average. So a lot of debt. Telecom companies typically do have a lot of debt. And the question is, how much fiscal support will there be for updated US telecommunications infrastructure? Right? They're not the only ones that are footing these projects. And so generally speaking, I think that there are better opportunities in the telecommunications sector than telecom companies, because they tend to be incredibly levered businesses. Their margins tend to be all over the place because of it. And for a lot of these big carriers, they're losing market share. I like where they're going in terms of laying that fiber, but I just think there are better places to put your money. So I'm going to say, for AT&T, going to have to pass. Alrighty, let's keep things moving and play another question.
I wanted to know what you guys thought about Google's current valuation. I added Google to my portfolio when it was down, and I wanted to keep adding more. Just a little information on me. I'm only 28, so Google would be a long-term hold in my portfolio. Can't wait to hear you guys answer this on the podcast. Thank you.
Alrighty, let's take a look at Google. Obviously, Google renamed themselves the holding company Alphabet years and years ago. It is one of the largest companies on planet Earth. Where does it stand as of today? About $2.142 trillion. And it's had a rough year so far, down 8.44% year to date. One of the things that has been propelling it, though, over the past couple years, right, with that solid outperformance relative to the S&P 500 in 2023 and 2024, is that AI secular growth theme, optimism around artificial intelligence. They've also had some pretty solid banking partnerships, but at the same time, right, you do have also some regulatory lawsuit overhang from an antitrust perspective. AI adoption within Gemini 2, I think, hasn't been as robust as what you've seen with OpenAI. And within the tech sector, it really is a first-to-market type of business. Now, they do have a buyback program that has been pretty strong, about a $70 billion buyback program. And unlike some tech companies, they've been pretty consistent with their dividends over the past couple years. From a relative valuation perspective, it's also one of the cheaper names right now, trading at 17.9 times forward-looking earnings, below an average of 22.2 times forward-looking earnings. They still do have dominant ad revenue. They still have pretty fast-growing cloud infrastructure business. Their AI service is strong. They had strong outperformance in Q1. Google's one of those names that I think has been strong for years and likely will continue to be a fixture for years to come. My big problem with Google from a thematic investing perspective is I have fully replaced Googling something with using ChatGPT or any of these other large language models that I think do a far more efficient job of finding my answer for me. So what is that going to do for ad revenue into the future as those tools become more ubiquitous? Within the Mag 7, I still think it's in the top half of Mag 7 names, but I would wait to see what quarterly revenue looks like in July before I bought into this thing. Wait to see what guidance looks like as well. I'm really keen to see what has happened with ad revenue growth over the past quarter as these LLMs become more adopted. That is Alphabet or Google. Thanks for the call. Alrighty. One of the sayings that has swept across markets is that nothing ever really happens. On June 13th, markets initially dropped about 1.6% on rising Middle East tensions, but guess what? They recovered. If you recall, there was a market drop-off after Liberation Day, but guess what? Markets recovered. You had India and Pakistan clashing. That caused pretty much no impact on US markets at all. You had the Wagner mutiny. Remember that all the way back then? When they were marching towards Moscow, driving towards Moscow? A little bit of a dip, then nothing happened. You had China protests. Markets were just shrugging them off. And one of the reasons why is because retail investors have been net buyers of around $20 billion in stocks, billion with a B, over the past 3 months. And this isn't just a trend recently. You can go back to a study in 1988, MIT and Harvard found that major world events typically caused only modest increases in stock volatility in the medium term. Markets tend to struggle to price all or nothing geopolitical risks like nuclear war, often opting to ignore them entirely. One other thing that may be helping out in this instance is really the growth from 2018 and onward in terms of the US's production of energy, production of natural gas, production of oil. We aren't as worried as we were, let's say, in the 70s or the 80s of issues in the Middle East because the US is the largest producer of these energies. Another reason could be because people are generally just worried more about earnings growth than anything else. Understanding that markets typically shake off these things, that this is one of the reasons why investing for the long term and holding through these things is of the most benefit to investors, has allowed investors to continue to shrug them off. Now, there's a difference between that and what we're seeing geopolitically and what we're seeing economically, right? Tariffs, real economic changes do potentially pose a big threat to markets. Why? Because they affect the thing that I just mentioned, bottom line earnings for companies. But it's important to understand that as you get anxiety, as you get nervous, uncomfortable about some of the geopolitics and geopolitical things happening around us, understand what drives markets. So long as retail investors are willing to continue to be net buyers of billions and billions and billions of shares, that type of market structure will continue to float markets through all of this geopolitical uncertainty. All right, here comes another question, this time from a listener in Tennessee.
This is Tommy from Nashville. Love your program. I really wanted to ask, my employer recently started offering a Roth 401k. And they've always offered a traditional 401k, which I've been contributing to. My question is, should I start to transfer my funds into my Roth 401k, or should I leave it in my traditional? I still do have a Roth IRA that I've been contributing to and maxing out every year. So any advice that you guys would have in this, I would be grateful for. Thank you so much. Love your program. You guys have a great day.
Okay, so you can't really just directly transfer your money from your traditional 401k directly into your Roth 401k. You would need to do something called an in-service, in-plan Roth conversion. But like a traditional or typical Roth conversion, there are some tax implications. So because traditional IRAs, traditional 401k plans are tax deferred, right? They are pre-tax contributions. If you are doing this rollover, you have to pay taxes on the earned income in the account in the year that you are doing this rollover. And, this can be beneficial sometimes, but sometimes it can push you into a higher tax bracket. You can actually end up paying more in taxes and have a higher tax burden because you decide to do this. I think this is one of the main confusion points for a lot of people is not understanding the math of this. If tax rates are the same, right? If your tax rate's 10% and you have $100 and you're going to see a 100% return. Let's say you pay the taxes up front. Well, your $10 or your $100 turned into 90, 100% return makes it 180, okay? Let's say you pay taxes on the back end. Well, your $100, 100% return is 200. Then you pay 10% tax on that. That's 20, you get 180. If tax rates are the same and the return is the same, a Roth and a traditional account would have the exact same return. And I don't think people understand that. The only way it is beneficial is if the tax rate is lower. If the tax rate is lower. If the tax rate has differences, that is where the benefits come from. And so you only want to do that conversion into that tax-free growth if you have the ability to take advantage of lower tax rates at the time at which you're doing the conversion. If this is your situation, if you have a low tax year on the horizon, if you think that your tax rate is going to be lower than it is in the future, then yes, it would make sense to try and do this in-service rollover. The next step would be to talk to your plan administrator, but understand the real cost here is the tax difference. Dial that in before you make a decision. Thanks for the call. All righty, we got some time, so let's roll in another caller question now.
Well, I appreciate your show very much. I learned a lot from it. I was wondering if you gentlemen could comment on Capital Federal Savings, ticker symbol CFFN. They're located here in Topeka. Whether or not you think they are currently a buy, a sell, or a hold, what would be your recommendation on that? And then maybe comment a little bit about the regional banking sector as a whole. I think those would be very instructive for me. So thank you very much.
All right, CFFN is Capital Federated Financial. It operates through its flagship Capital Federal Savings Bank. Not a lot of revenue, right? Only $29.6 million in revenue. So it is a very, very small bank, about $767 million market cap with quite a bit of debt, $2.1 billion in debt. Am I reading that correctly? Yes, I am. So, broadly speaking, one of the issues why this bank has flatly underperformed relative to the S&P 500 over the past 5-6 years, and why it's underperformed its industry in 2021, 2022, 2023, is because there are additional risks with regional banks and concentration. And that's why I would have to say that, we are still staying away from regional banks. You have a situation where the long end of the curve is misbehaving, if you will. Yields are very volatile in a way that they typically are not. And so understanding that you have loans on books of banks and rate changes, should they have to sell those bonds in order to fund redemptions of deposits, can negatively affect balance sheets of banks, right? Think about what happened in the banking crisis in 2023. Understanding that regional banks are asymmetrically exposed to this, and that in times of economic uncertainty, yes, you can have higher returns from them, but they carry higher risks, leads me to stay away from banks, especially ones that are this small, regional banks, especially ones that are this small, under $1 billion, very small revenue, low depositor base, low asset base, meaning that they don't have as much oversight as some of these larger banks. So given the climate, I would likely stay away from Capital Federal Financial Inc., as well as other regional banks, tilt towards those larger banks in times of bond rate volatility. Looks like we have a live call. Let's go to Tirth in San Jose. You have a question about your 401k?
Yeah, hi. Thanks for taking my call. So I recently changed my job, and I have 401k with my old employer, which I want to roll over. So I wanted to get information like what would be a better option between like traditional IRA or Roth IRA. And like I'm also happy to answer like any relevant information from my side which can help with this decision. So like I'm 30, I don't need that money for like long time. I do expect to get in like higher tax brackets as I move forward in my career. But yeah, and I have like 5 years worth of like 401k amount in my like old account. So.
Okay. Yeah. So the first thing I would do is I would want to roll it over into a traditional IRA, probably nearly immediately. And the reason why is because when you keep something in a 401k account, you are you could be paying a plan fee, right? Sometimes companies swallow those fees, sometimes they don't swallow those fees, but they tend to be more expensive and your options tend to be far more limited. Now, if you wanted to do a Roth conversion, you don't have to convert to the full amount all at once, right? And so one of the strategies for converting from a traditional IRA into a Roth IRA is to only do it as much each year such that you don't push yourself into a higher tax bracket. And so as we just mentioned, to a previous question, the key here is about minimizing the amount of taxes that you are paying. Mm-hmm. And so for some people, it also makes sense to just keep it in a traditional IRA because they aren't going to be earning any income in retirement. And so they're going to be in a far lower tax bracket. And so, this is a question that is very person specific that you would likely be best advised to consult with a tax professional who can look at your full situation and give you some options. It's something we do for our clients at KPP, but we need to see all of their information in front of us. And then we have tools that help us decide the amount and whether or not we're going to delay or do it all immediately. But the first thing I think you want to do is get it out of that 401k into a traditional IRA, give you more investment options, and save you some money potentially from those plan fees. Thanks for the call.
Great. Thank you.
Alrighty. Brief talk about the Senate-passed Genius Act to deregulate, or rather regulate, apologies, a little slip there, stablecoins and clarify reserve requirements. Stablecoins, it says, must be backed 1-to-1 by cash or treasuries maturing in 93 days or less. And Treasury Secretary Besson is saying, well, if you have to back things by treasuries, this could reduce borrowing costs. It could help our debt because if there's more demand for treasuries, then there is inherently lower rates because you don't have to pay as high a rate because the demand is so much higher. The increased treasury bill demand could let the treasury issue fewer long-term bonds. It could ease pressure on yields on the longer end of the curve, something that they have been particularly concerned about given the action on the longer end. Right now, T-bills are 21% of outstanding treasuries, and analysts are saying that it could rise to up to 25, 26% maybe due to this new demand. Now, there are some companies that are Amazon, Walmart, who've said they wanted to adopt stablecoins. I'm a little less bullish, if you will, on this. One of the reasons why people use credit cards to buy things is because credit card rewards. If you're Amazon and Walmart, yes, you want to issue stablecoins, but it saves you money because you save on the processing fees. But your customers need to be incentivized too. So does it create new rewards programs? Who really knows? Interestingly enough, as of right now, right, the $240 billion stablecoin market, it's mostly used for crypto trading. Again, there are those incentive issues for customers, whether or not they want to use them in those payments. And although maybe it leads to more treasury bill demand, if the system proliferates such that it is so widely used, there's nothing to tie them in the future just to stablecoin, or rather just to treasury demand. Because of this, the impact in long-term rates, kind of indirect, kind of uncertain. It could support borrowing cost stability over time, but all of that will be determined as we move forward. I'm Luke Guerrero. This completes another InvestTalk program. I thank you for listening and encourage you to tell your friends and family members about our free podcast downloads. Corner them at your next family function. Show them your phone. Say, this is InvestTalk. We love this show. I love this show. You'll love it too. You can tell them they can get theirs at iTunes, Google Play, and Spotify, and be sure to leave us a rate and review on iTunes. If today's show made you think about your financial picture, your investments, your taxes, your retirement, whether or not you can afford that vacation, and whether it's all really working, it's best to get a financial checkup. Just like going to the doctor, you don't want to wait until things get bad. You should probably do it at least once a year. And we will help you there. At KPP Financial, we offer no-cost portfolio reviews. Just head over to investtalk.com and click on Portfolio Review. As a reminder, best of show tomorrow. We will see you back here on Friday. Independent thinking, shared success. This is InvestTalk. Good night.